Good morning, everyone, and thank you very much for joining me. This is the Morning Market Review. My name is Russell Shaw. I'm a Senior Market Specialist at FXCM. Please take note of my email address, rshaw@fxcm.com. And of course, you are most welcome to send me an email if you'd like to correspond. And I will bring up our disclaimers to get us started. Tomorrow is a public holiday here, so we won't have a morning market review, but we will have a live non-farm payroll trade. And please join me for that. I've just put the link in the chat. Anyone who wants to participate is certainly most welcome. And you just need to click on the link and register. All right, I'll just keep this high risk investment warning up for a moment longer. Can you guys see me, hear me, and see the screen? Just want to double check that. I have made that error before where I talk and talk and talk. And thanks, Shadrach. All right, so Shadrach's given me the 3 yeses. Here's our market commentaries disclaimer. All right, so we'll do an analysis of the US DAX and the NASDAQ, but then I just want to introduce some financial math. So we'll do that. I'll try to get through the sort of technical analysis fairly quickly. And then I just want to talk about math. We'll keep it simple, but I think we'll introduce some very interesting ideas for us to potentially keep on top of. Hey Howard, morning to you. Nice to have you on the webinar. Thank you for joining. Thanks everyone for joining. It's much appreciated. In terms of our references, market scope and trading view, actually there was also, I wanted to show you the 2-year yield. The 2-year yield is a pretty good proxy for monetary policy. And you can see the black line here is the Fed funds rate, and the candlestick chart, that's actually the US 2-year yield. And if you can just take a look, every time the 2-year yield goes below the Fed funds rate, it seems to lead the Fed funds rate down. Similarly, when it crosses above it or moves, it leads the Fed funds rate up. Well, so just to give you an example, here it leads it down, here it leads it down, here 2-year crosses below, leads it down, here leads it down. Well, if we take a look where we are now, we're below it. We're below the US 2-year yields, below the Fed funds rate. So if this is anything to go on, it does suggest that we are at the top of that interest rate hiking cycle. And if that's the case, I just want to bring up a second chart here. Well, the US dollar at the moment is very closely correlated, I beg your pardon, with the 2-year yield. In other words, as the 2-year yield has been moving down, so has the US dollar been moving down. And we're just going to keep an eye on this correlation as well. Let's just take a look at the weekly correlation here. Weekly correlations also is 47%. Let's take a look at monthly. Monthly, so on a longer term scale, it's an incredible 90%. So I think that this relationship here is interesting. Okay, so we want to see if the 2-year yield moves down. Actually, let's do it a slightly different way. Let's change the 2-year yield to the Fed funds rate and look at the correlation between the dollar and the Fed funds rate. Okay, so you can see that the dollar here is, let's just go through to monthly. The monthly dollar here is at 72% correlation. It does oscillate, but by and large, we've got it above the 0 line far more than it is below the 0 line. Perhaps just as a little bit of a break here, but then we'd have to consider the global rates, what were global rates doing. But right now, as you and I are having this discussion, 72% correlation. Fed funds rate very much got a robust correlation with the US dollar. And then if we just take a look here, there's 2-year yield suggesting that we are at the top of this rate hiking cycle. So food for thought. What I want to show you guys next is the US dollar. I'm a little surprised at the US dollar movement yesterday. Certainly want to keep an eye on this. The reason that I am surprised is that the services PMI it still was over 50, but it was lower than anticipated. And the dollar has held up relatively well. You can see on the daily chart here, we've got 2 candlesticks, 2 blue candlesticks. But we are in zone 3. We are in zone 3, and it seems that we've pulled back to a confluence of resistance. Let's just talk about what I mean by confluence of resistance. Well, the first one is this R1 level. So R1, that's a mathematical construct. It's a pivot level. The trading room guys look at pivots and do trade between them. So there's self-fulfilling prophecy there. So keep an eye on that. Then here's the resistance. Okay, so let's overlap the resistance here. So you can see here's the confluence. So we want to just see if this resistance holds. I'm quite surprised that the weaker than anticipated services PMI wasn't a bigger catalyst. That to me is very interesting. Okay, but let's just keep an eye on this R1. So we've got the daily in zone 3. What would be an indication that the shorter term traders are lining up with the dailies? We want to see the EMA cross to the downside. We want to see the stochastic cross to the downside. See, the stochastic hanging out in this level here is completely on the wrong side. If there's going to be a downward swing, it needs to get here, okay, and hold. So let's just see if we get those signals. Now, I want to introduce the concept of buying the rumor, selling the fact, because this is more a question than anything else. To do that, just on that theme, keep in mind that the US dollar acted, in my opinion, slightly peculiarly yesterday. In fact, I thought it should be weaker than it is. Let's go through to NASDAQ. Okay. NASDAQ is in zone 1. It's pulled back nicely, but you can see that yesterday it really came down quite significantly. Now again, I would have expected that the bad news is actually good news for the stock market. So let's just explain that. We'll explain that in a moment. I'm going to try to do this sort of one step at a time. So we're going to introduce some of the mathematics in a moment. But let's just change the layout here to the main layout. Okay. Just take a looking at the NASDAQ. Going to the weekly chart. And we've suggested that there's this left shoulder, head, right shoulder. But what I think is even more important at this particular stage of the cycle is that there's been a shift in the momentum of the NASDAQ. It shifted from the green trend line to this orange trend line. I'm just going to change the color here. So the gradient here, what the trend lines don't give you a trend. That's done by peak and trough analysis. But once you've got the peak and troughs, you can measure the momentum of the peaks and troughs via trend lines, and you can see that it shifted up nicely. So what I what may be happening, what I think may be happening, but this is, we've got to be very cautious about this because I'm not certain this is what's happening, is that the NASDAQ has been responding in anticipation of weaker data. Why would it be responding in anticipation of weaker data? Because the interest rate hikes have been working through the transmission mechanism. We've seen weaker manufacturing data coming out this week. We've seen weaker services data coming out this week. We've seen the JOLTS report coming below 10 million. JOLTS report probably doesn't belong in that sentence because there is a 2-month lag in the JOLTS, but we'll put it was weaker than anticipated. Factory orders came in weaker than anticipated. And the idea here is, well, perhaps market participants are starting to take money off the table. So they anticipated the weakness. Okay, in other words, they bought the rumor and they're starting to sell the fact. Okay, so that's what may be happening. Okay, that's scenario one. Let's just take a look at DAX, and then we'll look at scenario 2, and I'm going to introduce just some mathematical variables there. Let's just bring in DAX and take a look at the trend here. And again, it's a terrific trend. Higher trough, higher peak, higher trough, higher peak. You've got such an interesting looking RSI, just nicely bouncing around, staying between 50 and 80, not moving overboard, not moving onto the bearish side of 50. It's looking really good, but you've got this weekly red bar, I beg your pardon, this weekly red candle that's starting to slip in. And if we go down to the daily, it's still in zone 1, and the stochastic is still in the upper quintile. That makes the support levels very interesting for NASDAQ. Let's get rid of all these lines. Okay, so this is interesting. It looks as if did I say NASDAQ? I meant the DAX. It looks as if the DAX here is getting signal 1. Signal 2 has already crossed. Okay, this might be responding to some of the weakness that we're seeing coming through. And if it moves up to the upper quintile and holds in that upper quintile, okay, the key is holding in that upper quintile, then we potentially have a swing on our hand. See what I mean here? Here it holds the upper quintile beautifully. Terrific swing. Okay, if it hits upper quintile and drops out, that's no good. The swing's it's not going to stick. Okay, so it looks like we're getting an interesting movement here on the DAX. Let's just go back to dollar. If we're getting this movement on the DAX, then what I'd like to see on the US dollar is I'd like to see it rolling over. Okay, so I'd like to see the R1 and the price resistance playing out with one another. All right, let's just talk about resistance, and then I'm going to introduce some of the math, and then we'll conclude. So just remember what resistance is. There's 3 types of market participants. There's going to be longs, there's going to be shorts, and there's going to be undecided. So what's happened effectively over here is the shorts have made money, and they think, wow, this is really a good level. It comes back to it. They go, oh, well, we're back at this level. Let's short again, and I've made some more money. Theoretically, it comes back to this level. They think, wow, we're back at this level. It's expensive for the dollar. Let's short again. Let's short again. So that adds to the resistance. At the same time, the longs over here are holding losses. So it comes back here. They start selling out of their positions. Well, if you've got shorts that are shorting and you've got longs that are selling, well, that's got the downwards pressure. And then you've got the undecided. The undecided is going, I wish I went short here. I wish I went short here. Oh, wait, it's come back here. I'm getting another chance. Let me go short. So that's effectively what's happening with the resistance. So let's see if this resistance plays out here. Let's just take a look at DAX again. Okay, DAX looking like it's getting a nice signal here. Let's just take a look at NASDAQ. All right, NASDAQ also potentially starting to show some signs of support. So maybe that weakness is starting to present itself as good news. Now, what do I mean by that? So let's just bring up some mathematical variables just to discuss this, and we won't go too hard into it or too deep, but I think that we've got the time value of money calculation. It's simply future value equals present value, okay? 1 plus, and I'm just going to use interest rates here. It's not really interest rates in the financial sense. In the financial sense, it would be a required return, but and then to the n. Okay, let's drop out the n, which is time. Let's rearrange it as follows. Present value equals future value divided by 1 plus r. Okay, so what I want you guys to concentrate on is on FV, which is future value, and I want you guys to concentrate on R. All right, so let's just talk about interest rates first. If interest rates go up, okay, then your present value is going to go down. If interest rates go down, which is what we are suggesting, okay, remember what we're suggesting here. We're suggesting that the 2-year yield has broken below the Fed's funds rate, and when that happens, it tends to pull interest rates down. Okay, if that is the case, we're talking about interest rates moving to the downsides. So let's take that out, and then we would push that down. And if interest rates are dropping, it would be supportive for present value because of the mathematics, because present value is on the numerator side, interest rates on the denominator side. So there's an inverse relationship. So if the interest rate drops, then present value has to move up. Now, that is where bad news is actually good news. In other words, we've seen soft economic data suggesting interest rates have to come down, or then present values have to go up. Where it's going to potentially get tricky, and I think that this is going to become a bigger theme, is on the future value side. The future value side, now what we're talking about is recession. Okay. In other words, if there's a recession, then the future values of risk assets become under pressure. Well, if future value becomes under pressure, okay, then it's going to be moving to the downside. I'll make this red. Okay, and if that's moving to the downside, then it's going to add downwards pressure onto the present value. I think we have to just be very careful about what's driving the markets. Is it the risk of recession that's going to be driving the market? That's going to be driving the future value element, or is it the interest rate that is going to be driving the market, and that would have an inverse relation on the present value, or is it going to be a net between the two of those? So effectively, up until now, bad news has been good news because interest rates has been dominant. Okay, interest rates has been the dominant variable. Now, all of a sudden, we're starting to talk about, and I heard it really for the first time yesterday on Bloomberg Surveillance, where they were talking about bad news is actually bad news. Well, that's where does the recession become dominant? Okay, I don't think we're there yet. But it's starting to be introduced into the discussion, and I think that we've got to be cognizant of just being on top of that. So at the moment, we're just going to introduce that concept here. We're not going to pick it apart just yet. I think that the interest rate cycle, to me, still seems to be playing out. Why do I say that? but it looks like we're getting these bullish crosses in NASDAQ. Looks like we're getting the bullish cross here in DAX. And it looks like we're getting the bearish cross in the US dollar. Okay, so let's just keep an eye on that. I think it's going to make for fascinating discussion going forward. All right. If there are any questions, please go ahead and type those in. I want to remind everyone that there is not going to be a morning market review tomorrow, but there will be a live NFP trade. Why is there so much hype about the dollar losing its power as the best currency? Not the best currency. It would be sort of as the world's base currency. I don't know. To be honest, I don't buy that hype at all. I don't think that it can lose that definition, so to speak. Any other questions? So the dollar, just to not the base, the reserve currency. Okay. So I think that yeah, it's a news topic. So that topic, by the way, how it's been floating around for years now, is the dollar going to lose its reserve status? It's just impossible. I don't see how any other currency can usurp it. It's just too big. All right. I think let's wrap up here, guys. Thank you very much for taking the time joining me this morning. Remember, no morning market review tomorrow. No morning market review on Monday either. So we're going to be back on Tuesday. But just to reiterate, there will be a live trade tomorrow. I'm going to post the link once more in case anybody doesn't have it. It's in the chat. You can go there and register. The last few have been pretty good, but I think the market is getting now a little bit more complex with the time value of money. All right, let's wrap up here. Thanks very much, guys.